summarize, secondaries are therefore very difficult to see at scale, 10, 15, 20, $50 million, unless the company itself is worth $500 million. Because 2% of if you're selling down 2%, it's not even making $10 million then. Why would an institution sell? So people say, oh no, there are secondaries before that. What is that? That's usually cleaning out of angel investments and micro-VCs. So this is the distinction. I think angel investments and micro-VCs, which are typically less than 50 million, would love to see 5, 10 million, 4, 5 million. Angel investors invested 100K, see $500,000 back as early as possible in the journey. So they're okay to take secondaries even at 100, 200, $300 million valuations. But for a fund like us, now that we're managing 100 plus per fund, even to return 10 million, I have to sell down 2%, and I probably own 8 or 10% in that best company. I don't want to sell down so much so early that I don't even have any residual upside, and therefore we don't sell much below the 500 million valuation. We have not voluntarily sold secondaries below that price yet. The only reason we did it was end of life. So when the fund reaches its end of life, then we do what's called a continuity vehicle, and we pass on the positions to a new set of investors. But because they can't manage those positions and they can't get board seats, etc., they request us to continue to manage it. Because for one or both of those reasons, because we have history with the company, the founder has enormous comfort with us. So the position 4, 5%, 6% gets better managed. And so they put that onus on us saying, hey, I'm not buying this unless you're sitting and managing it for me. That's why it's a term called continuity vehicles, though they call managed secondaries. So you continue the positions for longer. Hopefully everybody continues to make 20% plus IRR, which is why they're giving you that option. If it's not making that kind of money, no one's interested. But think about it, much like M&A, which we talked about, the secondaries as well, if people don't think they can make 20, 25% IRR, they're not going to buy it. So there's no easy pass. Some people ask, oh, there's a round happening, why aren't you getting a secondary? The confidence has to be so high that it's going to generate that. Otherwise, most investors or most companies get one term sheet, after pitching 40 people. So you don't want to spook that one person saying all of us are running out of it. So confidence has to be so high that instead of 50, they want to play 100 million. That's when they come into secondaries. So limited partners or LPs or investors in a fund would love to see as much capital back as quickly as possible. That said, they don't play venture for muted returns. They're not playing it for capital plus. They're playing it for a huge multiple on the capital. So if you exit too early and deliver 1.5x in 5 years and say that you delivered 15% IRR, they're not going to be happy. So they actually still want the 3x and the 4x. But they want you to have a certain discipline and a rigor of trying to deliver as much of the principal back as quickly as possible. So your IRR meter stops, right? Because you've given, it's not a negative territory, it at least reaches zero, because I've at least given the principal back. So they do obsess about take some money off the table. That's why secondaries become important, number one. So there are 2, 3 ways why there's pressure to do secondaries. One is to return as much of the capital back, somewhere between the 5th and the 8th year, 5th and the 9th year. So in that time frame, therefore you don't force a secondary, but your early breakouts tend to start hitting blockbuster valuations in that time. So their ask typically of us, we've noticed, is take some off the table. So if you have a blockbuster hit, which is basically 8% of $1 billion company, it's reached $1 billion. You're sitting on paper value of $80 million. So they're not saying sell down all 80. They're saying, why don't you sell 15 or 20? Because you only invested 5 or 6 in this company, or 8 or 10 in this company. So you get 2x of your capital back. You've gotten 20 million, you've given that back to me in the account. You're still riding 60. So if it is going to triple from here, one argument could have been that, hey, you made me sell 20, we could have made 80 into 3, $240 million. Instead, you took out the 20 million and tripled the 60 and got 180 plus 20, which is $200 million. They're saying we're okay to trade that safety. So it's our money as well. So be prudent in the way you make decisions. When companies are breaking out, take some money off the table. So that's one form of secondary between the 5th and the 9th year. And then the second is when it's 9th, 10th, you hit the fund life end and then you're sitting in extension periods. Your fund is reaching end of fund. So there is a push to get more and more of that capital back as close to the target. And by then you don't have excuses. At least in half your winners, the early breakouts, the company is reaching its potential of going public or going to that mark. And from there on, the belief is that it's not going to compound at 30-40%. It's going to compound at 20-25% because the business is stabilized. Say, why are you waiting? Just get out now, because I want you to maintain that 25% IRR. Unless the company is on some crazy tear and it can actually outpace 25%, I'll buy something else that can give me 20%. I don't need you to hold that position to give me 20% for the last 5 years. So get rid of most of it. And that's why two big secondaries happen. One towards end of life and one towards middle of life.